It was a pretty calm day in the United States stock market with the S&P 500 closing lower by 0.2%. Most of the Magnificent Seven companies were down during the normal session, but today's big news was actually what was happening in the after-hours session. NVIDIA was the final one of the Magnificent Seven companies to report. They came in with very strong numbers. However, the stock was trading lower by a couple of percent after hours. So we'll take a look at all of that information, see what it means for our posture. We'll take a look at our various 12 grids in tonight's video. Also, with our Black Friday sale coming up, I'm going to show you where to apply the coupon code so that way you can save 20% off of our premium subscription. And then in our trade application example, we're going to take a look at the insurance sector, which has been sneaky strong here this year, and see if there's an opportunity for a bullish bounce trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 21st, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list. Remember, at the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals, in addition to notifying you when these videos are ready to be viewed. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, we would encourage you to follow us. My handle is @BrandonVanZ. We really appreciate those of you that click like and repost on this Market Outlook related content. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see listed in the logo in front of you. And let's go ahead and jump into today's trade activity. As you can see, I've got the S&P 500 heat map pulled up here in front of us, and it was a bit of a mixed session here today. We actually did close a little bit lower when it was all said and done, but you can see it wasn't necessarily a landslide. It kind of felt like a sleepy day here today. Of course, this is a holiday shortened week, and so that may have impacted things to a degree. For those of you that are our global viewers, reminder that here in the United States we'll be celebrating Thanksgiving on Thursday, and will be a holiday shortened day on Friday as well. So oftentimes when we have a holiday week like this, the volumes start to dry up a little bit and people start taking their vacation days and things like that. So it does make me wonder if that's maybe part of the story here today. Nonetheless, always something to dig into. So let's see what we can discover here today. Let's get started, as we often do, with the Magnificent Seven. Now, I'm going to start with NVIDIA here today. It was only down 0.92%. But the reason I'm starting with that here today is because that is the stock in focus this afternoon. Now that the stock market has closed, they were the last of the Magnificent Seven to report their earnings this quarter, and looks like the earnings actually were pretty strong. I think revenues tripled from where they were a year ago, just to put that into perspective. And remember, we're not talking about a small company here. We're talking about $1 trillion market cap. So to triple your revenue is rather amazing, but the stock is trading down lower, just a little bit after hours. Last I checked, it was down less than 2%, so not a very big move at all after hours. Remember, earlier in the year, we had a dramatic move higher in the after-hour session when they reported their earnings. This time around, kind of feels like a little bit of a yawn. So companies still certainly heading in the right direction, and they're on track with immense amounts of growth. The question, as always, is at what valuation do you pay for that growth, right? It's not just as easy as identifying a stock that is growing its business. That is rather easy to do. It is making sure that you're also buying it at an appropriate multiple. And so that's what the market seems to be grappling with here at the moment. Of course, NVIDIA has had just an extraordinary year. So even if it flatlined from this point forward till December 31st, this will likely be the year that NVIDIA was considered the story stock of the day. So we'll see where things shake out tomorrow morning, but here at the moment it's down less than 2% after hours. Microsoft closed lower by 1% here today. Of course, Microsoft has been in the news here over the last week or so. I think most of the news has broken since I was last with you on Thursday. But over the weekend, I think it actually hit Friday, the news came out about Sam Altman, the head of OpenAI. Of course, Microsoft owns about half of that company, and the board apparently let Sam go, and not necessarily saying why, at least not with specifics. And so that caused a little bit of a jolt into Microsoft shares when that news broke. But interestingly enough, as the weekend went along, it was then discovered that Microsoft could very well end up hiring Sam directly and starting its own internal artificial intelligence type of program to maybe compete with OpenAI and ChatGPT, or perhaps just work in conjunction with them. It's kind of up in the air right now. Some of the details are not being made public, but it has been kind of the talk of the town in the tech world, and there's been a kind of a revolt at OpenAI after the employees heard the news about the board firing Sam, and it's just been quite dramatic. It feels like a soap opera to me as an outsider. Nonetheless, Microsoft obviously heavily involved in that and has been riding the wave of AI for much of this year. They are a $2.7 trillion company these days. Today they finished lower by just over 1%. Apple was down today by 0.42%, so not a particularly big day there, but down about 0.5%. Meta was down about 0.88% here today. Alphabet was down, Alphabet was up 0.5% today. So they kind of bucked the trend here. We did have Amazon closing lower by 1.5%. That stock has also been in the news here lately. Those of you that didn't hear it yet, apparently Jeff Bezos, of course, the person who started Amazon, and while he's not as directly involved with the day-to-day operations any longer, he still has very much the brand of Amazon upon him, and vice versa. Those two things are kind of in unison with one another. Nonetheless, Jeff has moved on. Apparently he's getting married, from what I understand, and is tapping into his enormous share of Amazon shares, and therefore now selling some of those. And so that's caused a little bit of consternation within the market, wondering, how many shares is Bezos going to sell? Is this going to be something that's going to, keep a lid on the stock price growth in the immediate future? So today it was on the wrong side of the ledger, down 1.5%. Tesla was the big winner from the Magnificent Seven perspective today. It was up just over 2%. So even within the Magnificent Seven, you can see it was kind of a calm and quiet day. Not a whole lot of movement there. No aggressive movers in one direction or another. We did have some of the smaller companies making maybe more aggressive movements within the market. A lot of those were related to earnings announcements. One that kind of stands out to me right directly in the middle of our screen there is Medtronic. This is a dividend aristocrat company. In fact, we just bought it in my dividend class 1 week ago, so we were enthused to see the response to their earnings here today. That stock was up 4.6%, one of the bigger performers within the market. Other companies that managed to close in the green, you can see some of those healthcare giants like Johnson & Johnson, United Healthcare, both closed higher by about 1%. There's a smaller green patch right here. This is Agilent, ticker symbol A. They were actually the best performing stock in the entire S&P 500 today, up almost 9%. Again, another earnings announcement there. So those were some of the bigger movers. Let's see what else is out there. CME Group, Chicago Merck, was up 1.68%. In fact, that stock was on my short list for potentially bringing to your attention for tonight's market outlook trade example. I ended up going a different direction, but that chart looks kind of interesting right now as well. And if I'm not mistaken, I believe Chicago Merck is the company that oftentimes does a end of year special dividend as well. And since we're getting closer to the end of the year, I wonder if the market is already baking that in or not. And if not, then maybe there's an opportunity there. But that might be something for you to investigate on your own time there. A lot of the insurance companies were up again today. So Progressive and Travelers and Chubb and ACGL, which we'll talk about later, and then the Hartford, Aflac, all those types of companies were up. Remember, the insurance companies have kind of been a quiet niche within the market that has really been working nicely. They're not very big companies, so that's why you just don't hear the press talking about them nearly as much as you would assume. But if you go through their charts one at a time, you're going to see some pretty strong trends that are in play, and they even were in play this fall when a lot of the other stocks were really struggling. The insurance companies just kept on motoring higher, so keep your eye on that area as well. A lot of the consumer staples were up today. Walmart, Coca-Cola, Pepsi, Costco, Target, Dollar General, Colgate, Philip Morris, Kimberly-Clark, Church & Dwight, Clorox, Kenvue. A lot of those were in the green here today despite the red day in the market. Remember, unlike the insurance companies, the consumer staple stocks have just gotten blasted to the downside this year with their interest rate sensitivity. And so it does make you wonder if market participants are trying to find value if it exists out there. We actually had a long discussion about the consumer staples sector in our dividend growth investing class that I taught this morning. You can kind of think of it as a pre-Thanksgiving celebration because we talked about a couple of food-related companies that had been really out of favor here this year, and their dividend yield is appearing to be quite attractive here at this moment. In fact, one of the two is a food company that in the 12 portfolios that I've put together just here at Market Scholars in the last 5 years for dividend growth investing, we had never talked about it a single time, despite it having decades worth of dividend growth under its belt. So like I mentioned to the students here today, while this has been a difficult year for dividend stocks in general, there's always a flip side of the story. And where there's a little bit of pain for the stocks that you might have already purchased, it also comes with the opportunity of stocks that you have not yet purchased that might very well show up on your lap. And that's what we attempt to do each week in my classes, is look for those opportunities. And right now, the pool is wider and deeper than it ever has been in terms of potential candidates for dividend growth investors, where we have nearly half of the 700 companies that we track that have at least 5 years in a row of dividend increases are trading in what we would deem to be acceptable territory based upon average high yield theory. In other words, stocks that are trading in the blue zone of the dividend stair-step chart. So right now, we're kind of in kid in the candy store mode in my dividend growth investing class. Let's talk about some of the losers here today. A lot of the tech stocks seem to be down today. So you'll notice that it was not just a NVIDIA, Microsoft, Apple story. You had a lot of other software companies that were down. Salesforce was down. I saw Mark Penioff he's the founder of Salesforce, and he basically came out and said, hey, anybody who wants to leave OpenAI as a result of the aforementioned Sam Altman story, you've got a place at Salesforce. We'll hire you on the spot. We'll pay you the exact same amount you were getting paid before, plus all of your benefits. And so you can see it's a little bit of a arms race in a way in Silicon Valley for top talent that revolve around artificial intelligence. And so Salesforce is down a little bit today, but certainly in the news for that reason. You can also see a lot of the semiconductor stocks really struggled here today. They had been perking up here more recently, but today was a bit of a give back. Intel had been really heating up. I know it's kind of amusing to say because it seems like Intel is the down and out variety of the kind of forgotten about old line tech, but its chart has actually firmed up really nicely here lately. But today on the wrong side of the ledger, down 2.5%, Broadcom down 1.5%, AMD down about 2%. You can see the rest there. Pretty much everything in the semiconductor and semiconductor equipment space was down here today. You can also see some of these smaller sectors over here were down as well. So like real estate, mostly down here today. Energy, mostly down here today. Utilities were kind of hit and miss. It just kind of depended. It was about a 50-50 shot as to whether your utility was up or not. But it seemed like it was pretty obvious that energy and real estate really struggling here today. All right, let's go ahead now take a look at the specific breadth numbers. Coming on over here to the Market Watch tab, let's go over to the Visualize area. Let's pull up the Index Watch and then take a look here at the S&P 500. So you can see that it was a pretty split day for all intents and purposes. 230 stocks out of the S&P 500 closed in the green. So, not that far away from a coin flip here today. Again, with most of the Magnificent Seven stocks in the red today, they're going to have a bigger impact on the market cap weighted S&P 500. So that is part of the story as to why the S&P 500 itself closed lower here today. Speaking of which, let's take a look at our 4-grid now. As you can see, this is chart 4B for those of you that are following along at home with your own charting package. Remember, that is one of the more valuable things that we provide to our 3-year premium members, which I'll talk about here in just a little bit. I think David probably talked about that in the video last time as well, but this is our once per year sale that we put on. Many of you know we are not highly promotional in terms of throwing sales at Market Scholars, but once a year we kind of get into the mode of the Black Friday sale, just like so many other companies do. So I'll kind of explain that a little bit later, but just a reminder that we do offer over 50 customized charts that are built using ThinkScript programming code that you cannot get anywhere else. And some of our students really enjoy being able to access those while David and I are teaching our classes and our presentations, and then using the charts for their own trading even when they're not in our classes. So anyway, this is chart 4B for those of you that are following along right here. And the way that this chart package will work, this particular chart 4B will work, it's a 4-grid, and the background color behind the current candle will tell you whether the intermediate posture on the market forecast technical indicator is bullish or bearish. So as you can see, behind today's candle on all 4 charts, we remain with the dark green shading of the background. So what that means is we still have strongly bullish intermediate postures using the market forecast technical indicator. The market forecast technical indicator is that indicator you see below each of the 4 charts, and it consists of a green line, a blue line, and a red line. David has been using the market forecast technical indicator at this point for probably about 20 years. I remember when I was working at headquarters for TD Ameritrade in Omaha, Nebraska, before I had any idea I was going to move out to Utah and take a job as a coach at InvestTools, where I would eventually meet David. And anyway, when TD Ameritrade announced that they were buying InvestTools, I was actually reading the daily paragraph or write-up that David would put on their website. At that time, he was not doing a video the way that we do now. He was just writing up a quick little paragraph on it. So it's kind of interesting to see how things shake out in your life, going from that moment of living in Nebraska, not knowing anybody in Utah, but knowing David's name, and then eventually moving out to Utah, where I eventually met David, and then here we are, long story short, together at Market Scholars. But anyway, I was working at TD Ameritrade's headquarters 15 years ago, and he was already doing that. So that is, I think, another kind of understated benefit of joining Market Scholars, is to be able to pick the brain of David Settle on a indicator that very few other people have a handle on to the same degree that he does. Like, I would consider him one of the world's foremost experts in the market forecast technical indicator. And you guys would get an opportunity to work with him hand in hand to help understand the different trade setups and how to read it and interpret it and all that kind of stuff. So anyway, there are 3 different lines on the market forecast technical indicator. There's a green line, there's a blue line, there's a red line. The green line is kind of what we would consider our default line. This is kind of the standard line. It is technically referred to as the intermediate line. So if you ever hear us say the posture of XYZ is bullish or XYZ is bearish or whatever, and if we don't state anything else other than that, just assume that what we are referencing is the intermediate posture. Now, the near-term line can also have its own posture, and technically the momentum and market sentiment do as well. It's just that if we are referencing those other lines, we will explicitly state that. When we just say generically the posture is, then more times than not we are referencing specifically the green intermediate line, which is what we consider the default line. So the way that these charts are built is the background colors will switch from green to red with different shadings that are associated with it based upon what is happening with the green line on the indicator. So you'll notice here that, for instance, the S&P 500, that green line is way up here. Remember, it works on a 0 to 100 scale. So the labels, you can kind of see the number a little bit easier. The current reading of the intermediate line on the S&P 500 is 96, nearly 97. It does not go above 100. In fact, I'm not even sure. Yeah, it probably touches exactly 100. But the point is we're really, really close to the top. And some people might think, well, if it's so close to the top of where that indicator maxes out, then surely it's going to fall, right? Because it can't go any further. And that is partially true. You can't break through 100, but what you could do is you could stay at 100 for a long, long, long time. And you can see how that has shaken out already with that green line down below. It is right here when the green line emerged out of the lower reversal zone where we first consider it to be bullish. Now, at that first part, it was considered weakly bullish. Notice that the background color of the S&P 500 chart at that time was that light green color. So that was about a week after we got these oversold cluster signals, right? We talked about those in real time as they were happening as well. For those of you that didn't catch that conversation, oversold cluster signals occur when you've got the green line, the red line, and the blue line in the lower reversal zone below 20 on the same day. And that happened back-to-back days here. That's why you see these little green dots show up on the chart. And it's not like they are planted after the fact. They are getting plotted in real time, which makes them valuable, at least to me. And hopefully by looking at this chart, you can understand why they are valuable. Because when you look at this 3-month chart right here, there's an obvious bottom that was formed, and it's not a coincidence in my mind that it was formed exactly when there was an oversold cluster signal. Remember, that was actually the first ones in a year. So while we had other pullback days back here in March and then also back here in late December and early January of last year, we didn't have that instance where the green, the red, and the blue were all in the lower reversal zone at the same time. This one was really close. The other closest possibility of that occurring would have been back here on March 13th. But technically the red line was at 22 that day. It needed to be below 20. But you can see that had it been below 20, that would have been another outstanding candle to be expecting a reversion to the mean type of a move. So that's the way that you can kind of think about those particular trade setups there. So anyway, these cluster signals and these little green dots that show up on our Market Scholars charts are quite valuable because they tell you that the selling has gotten too extreme and that you should be awaiting some sort of a reversion to the mean type of a move. Now, admittedly, I did not expect it to be this aggressive. I expected a reversion to the mean move and then to kind of take it on a day-by-day basis. What has developed has been really, really amazing, and it was kind of supported by falling interest rates during that time period. So this one worked out better than most other oversold cluster signals work out. Nonetheless, hopefully it shows you the value of those particular signals. But when the green line is up here close to 100, it's basically telling us that the intermediate posture is strongly bullish. It's been weekly bullish since November 2nd. It had a couple of days there with that weekly bullish kind of lighter green shading there. And then starting right here on November 6th is when it went to strongly bullish. And even there, you can see that the market was at 43.63 at that moment. Some people would say, well, the biggest part of the move is already out of the way. Well, you can see we were only halfway done with that move compared to where we're at right now. So even if you would have just waited until you had strongly bullish posture, even if you didn't get in on the weekly bullish posture, you still had a lot of gravy there to lap up this time of year as we're thinking about our turkeys here in the United States in a couple of days. So anyway, no surprise that with today's moderate day of only a 0.2% pullback, we do remain with a strongly bullish posture. That will likely be the case for a while, right? Because this green line will have to fall below 80 before it's no longer bullish. And, you know, with it being close to 100 right now, it's either going to have to require an extremely sharp sell-off, or it's going to have several days of small sell-offs. But either one of those is not likely. And therefore, we should assume that at least for the next several days, we'll probably continue to have strongly bullish posture on the S&P 500. In terms of the other charts, you can see the Dow was down almost exactly the same amount as the S&P 500 today. It was down 0.18%, and similar to the S&P 500, we remain with a strongly bullish posture. And similar to the S&P 500, that green line is up there at 96, so it's not going to go to a bearish posture in the next couple of days. You can see down below on the NASDAQ composite in the lower left, that one was down a little bit more today because, again, today was one of those rare days where the tech stocks, especially the Magnificent Seven, had a outsized impact of selling. And so NASDAQ was down 0.59% today, but similar to what I had mentioned with the other two, clearly we continue to have the strongly bullish intermediate posture. Green line is still way up there. In this case, it's at 95. So we've got a little bit of grace period there, and I would not expect that that will change to a bearish posture in the next few days. The Russell 2000 is a little bit of a different story than the other three, right? The Russell 2000 small caps were the ones that were really out of favor for the vast majority of the fall and at a more aggressive pace. And with those ones, those clusters did not work particularly well. Eventually, the final ones did, but like we always say, it's kind of like the boy who cried wolf. If there is a index or an ETF or even a common stock that regularly produces clusters because it's just more volatile, then the signals probably won't work as well. If you are applying that to an index, an ETF, or a stock that rarely produces clusters, then those are quite a bit more impactful. And that describes the S&P 500. As I mentioned, the two that we received were the only two in the entire year that we had. So it was a very rare event in that case. But the Russell 2000 has been out of favor much more so. Remember, the Russell 2000 has not had the benefit that the S&P 500 has this year in having it have exposure to the Magnificent Seven. There are 0 Magnificent Seven companies in the Russell 2000, so it's harder to prop that particular index up. But they did have a really nice move. We talked about this historic move right here. I was with you that night, and it was actually the second best day for the Russell 2000 in 4 years. So we've largely held those gains. We've been kind of digesting them sideways here for the last week or so. But at this exact moment, we would still consider this to be a strongly bullish posture. However, unlike the other three, notice where the reading of the green line is right now. It's at 80.96 and falling. If it were to fall to 79.99 tomorrow, that will change the background color of this chart. So we'll keep our eyes on that possibility. But while we have plenty of leeway on the other three charts where I would not anticipate a switch to a bearish posture, the Russell 2000 is very precarious. And if we have a big down day tomorrow for whatever reason, then there's a pretty decent chance that could revert back to the bearish posture, which it has been in for much of the last 3 months. At this moment, it's also worth pointing out that while the Russell 2000 was down 1.32% today, it did end up having a signal associated with today's move according to the market forecast, and that signal is a bullish intermediate confirmation signal. That occurs when the green line is considered bullish. So in other words, the background color of the chart is green because either the green line's in the upper reversal zone or it's between 20 and 80 and traveling higher. And on that same day, the red line is in the lower reversal zone. So the red line can't simply be just traveling between 80 and 20. It has to be in the lower reversal zone for that signal to exist. So we do have an official bullish intermediate confirmation signal here on the Russell 2000. However, there is one piece of it that makes it less ideal. Remember, the blue line we do like to see between 20 and 50, and we're getting that right now. The blue line is at 47. It tells us it's a little bit more of a healthy pullback. And today, more than 1% on a big broad index is a noteworthy type of a day for it. But on the flip side of that, unfortunately, the red line is at 0, right? It is literally reading 0.00. Remember what I said before, it's a 0 to 100 scale. It can't go above 100 and it cannot go below 0. So this is literally the lowest ranking or rating that you can have on that momentum line. And if that momentum line is at 5 or less, we consider that to be a pretty extreme reading, and sometimes that can lead to further selling. So, it's a little bit more questionable. I talked about that a week or two ago, how we had an idealized form of the bullish intermediate confirmation signal. I believe it was on that candle right there on the S&P 500, where we had the green line in the upper reversal zone, we had the red line in the lower reversal zone, but still above 5. It was at 7 that day, and the blue line was between 20 and 50. So on that candle right there on the S&P 500, that was considered an idealized form, and we got a really nice push up and away from that. So anybody who would have acted on that bullishly would have been rewarded. This one is interesting, but it does have that one little fly in the ointment there where the red line is below 5. So maybe it wouldn't be one of those where you put on a full position size or something along those lines. Now, the other thing that I would mention is with all 4 of these charts, you'll notice that all 4 of them have a green moving average. A reminder what that means in this case is price is above a rising 30-day moving average, generally considered a bullish feature for the charts. And so we have strongly bullish postures according to the market forecast technical indicator on all 4 of these, and all 4 of them are trading above their rising 30-day moving averages, which is also considered bullish. However, the Russell 2000, if it has a sell-off day tomorrow, it could very well be the first one to go back to a bearish posture. So we'll keep our eyes on that. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support our presentations. Remember, these do take a lot of our time, generally about 3 hours out of our day. And since we don't get paid to do them, we do them as a public service to hopefully get the name out about our organization and hopefully encourage you guys to eventually, spend some time with us on our premium side, right? So you can kind of think of, our current premium members as somewhat subsidizing these free YouTube videos. And if you're somebody that's enjoyed these videos that David and I have done for going on about 10 years now, including our time at our previous company, maybe this is the year that you decide, you know what, I've gotten a lot of value out of those two fellas. Maybe this is the time where I take advantage of the Black Friday sale. So I'll explain that here in just a little bit. But even if now is not the right moment for you, if you don't have the resources or the time or what have you, we do still appreciate you guys checking out these videos and helping support us along the way. Remember, David and I are a 2-man operation. We do not have a staff. We are just a couple of guys that are making a go of this whole entrepreneur thing, and we've enjoyed our experience doing it for the last 5 years, and we hope we have many, many years in front of us as well. So we couldn't do it without you. I know that for sure, and we certainly appreciate that. Have a lot of gratitude for all of our viewers this time of year, especially with Thanksgiving on the horizon. But last time around, special thank you to those 112 of you that were willing to click like for me there. As I always say, as long as we're up and over 100 likes, more than happy to give you a full hour-long video. If you prefer the shorter videos, then don't click like, and we can certainly keep it to 15 minutes if you prefer that as well. So we let you guys kind of decide that collectively. Let's go ahead and do some shout-outs of those 112 people. And let's say thank you to Brandon and to Jan and to Business News and to Marty and to Ron and to Yes It Was Fixed and to Neil and Chris and Craig and Viola and Steve and John and Oscar and Margie and Charlie and Michael and Ryan and Vernon and Roger and Easy and Fathy and BZ Japan, Susan and Trunk and Richie and Terry and Brad and Jim and Gene and Ray and Paul. The list goes on and on and on. Can't get to all of you, but I certainly appreciate each and every one of you. Please continue to keep that up on your side of the equation. Let's also have a little chat here about our sector selector tool. As I mentioned before, we had a busy day today. I taught my dividend growth investing class, and then David taught his directional option strategies class for our premium members. The sector selector is something that we actually use directly in my Monday morning top-down trend trading class. And so there we try to get a feel for what sort of sector rotation may or may not be taking place. A reminder that this is based upon the proprietary WAR score, which is an acronym that stands for Weighted Aggregate Returns, where we're taking the return information from a variety of time periods, but we're weighting the more recent ones more heavily. We're also using this on an equal weighted system as opposed to a market cap weighted system, and so that can have an impact sometimes on how the rankings get shaken out as well. But here's how things stood out this past time. Remember, this gets updated on the weekend, so it's a couple days stale by this point, but if you are a premium member, you'd have real-time access to it. Remember that technology was once the champion of all sectors here earlier in 2023, and then we went on this long run where oil stocks were all the rage. Well, oil, as you can see, has now dropped precipitously for 2 weeks in a row, finds itself all the way down here in 9th place when it was just at the top slot here a few weeks ago. So in its place, we now find technology. And technology, you might be tempted to think, is just because Apple and Microsoft and Nvidia have been going up. But as I mentioned a moment ago, that is not the case here because this is an equal weighted approach. So this is looking at all of the companies that are the tech stocks and equal weighting them so that one doesn't represent a bigger weight than the other. So we're saying that yes, it's true, Apple, Microsoft, and Nvidia have done fine, but they're not alone. There are a lot of tech stocks out there that have strong trends right now. In fact, we own 5 of them in my top-down trend trading class. So there's plenty of opportunities out there if you are looking for that kind of momentum-style trend trading approach towards the markets within the technology sector. Financials did slip to number 2. Remember, the financials are where you've got the insurance companies that have been very hot this year, but some of the other industries within financials have been kind of a little bit more hit and miss there. Industrials worked their way up to number 3. Remember, the industrials are more of a cyclical sector, so they generally require a stronger economy for their stock prices to do as best as possible. So hopefully that's a good sign now that we've had a reversal in the market here since the beginning of November. We're starting to see some of those areas that are more cyclical perk up a little bit there in that case. And then communication services rounded out our top 4 here. They've been in the top 4 for 4 out of the last 5 weeks, so they're no strangers to that area. But remember, I tend to consider the communication services area as tech adjacent. What I mean by that is some of the bigger drivers within communications are internet companies. You can think about stocks like Meta and Alphabet. You can also think about stocks like Netflix. Those companies are all technically communication stocks, but they kind of trade like tech stocks. So I think the renewal of enthusiasm around technology has somewhat supported communications there as well. On the downside, you do have, as I mentioned before, energy at 3rd to last, then you have consumer staples at 2nd to last, and then healthcare for the 3rd straight week is dead last. Now keep in mind, not all healthcare is doing poorly. Some of you have been keeping track of that CRISPR long calls trade that I did a couple of months ago that we still have live in our portfolio. I did notice that despite it being down today, it's still up over 200%. So that one has worked out very nicely, and it happened in basically the blink of an eye. As I mentioned on Twitter here, I think it was yesterday, they doubled from where they were less than a month ago. So in late October, they were trading at close to 37, and yesterday they traded up to 76, and that happened in less than one full month. So sometimes you get into some of those biotech areas, and they can really make a move depending upon how things are shaking out with the regulators and drug approvals and FDA panels and all that kind of stuff. The other area that has been working within healthcare is the weight loss drugs, right? They've done pretty well. It kind of has felt like a year where the weight loss drugs have received the benefit of the market cap losses of many of the other healthcare competitors that theoretically they're stealing business from, because the thought is if all of a sudden people are taking those weight loss drugs, they're becoming healthier. If they're becoming healthier, then they're not spending as much money on pacemakers and joint replacements and all this other kind of stuff. So whether that's true in reality, not really sure. I have a feeling that if it is true, it's not going to play out for a long time. But sometimes the market is a little erratic that way. Market cares about a story and sentiment, and right now that has been the sentiment. We'll see if that shifts. Again, earlier today with Medtronic doing as well as they did on their earnings announcement, hopefully that's a positive sign that not all those companies are just going to completely roll over either. All right, let's now have a quick little chat about our Black Friday sale. You can kind of see the banner up at the top of our marketscholars.com website. It says Black Friday sale. Get your 3-year premium plan for 20% off using coupon code Black Friday. Now, be aware that that is all one word, where the B and the F is capitalized, and it is case sensitive, so you would need to type it in exactly that way to get the 20% off. We'll likely be sending out an email. We probably will do that, I don't know, either on Thanksgiving or Black Friday itself, so many of you who are on our email distribution list will get some more details on it, but we always have people asking us where do you apply the coupon code, so we're trying to make a point of it here in these videos to visually show you, and that way we can have you go back and reference this part of the recorded video if you needed some assistance with that. So anyway, a reminder of what you receive when you become a 3-year premium member, and that's what the discount would cover, is our premium experience here, which is the kind of the graphic off to the right hand side. So first of all, most of our clients are premium subscribers. So we have a handful of people that will test us out for a month or two with our Plus subscription, but the vast majority of our clients are the 3-year premium variety, because they get access to basically everything that we offer. That includes all 8 of our weekly trading rooms. That includes the additional 2 weekly question and answer sessions, and that's where you would get an opportunity to work with David and I directly, right? It's not just you hear us talking and you're not having any association with us or what have you. You're literally asking David and I questions, and we're literally answering your question for you. Now, we can't give you advice, right? That's not our purpose. We will give you our thoughts, our opinions, our experiences, and all that, as David and I both have over 20 years of experience in the markets, but we can't ever give you direct individualized advice. We're not licensed to do that. Nonetheless, that's a good place for you to get your questions answered. If there are things that we're saying during these videos here or during our premium classes that you need some further tightening up on, we're more than happy to provide that support for you. We also have plenty of people that bounce trade ideas off of us for us to review for them and different things like that. So that's a nice little perk that our premium members would get, is not just the 8 trading rooms that we teach every week, but the 2 additional question and answer sessions. As I mentioned before, another big perk of this 3-year premium plan is that you get access to the 50 plus custom Thinkorswim chart scripts. We've spent a lot of time. I have no idea how much time. I couldn't even imagine just sitting down and figuring it out, but I can promise you it is thousands of hours that we have put into the development of our tools and resources, like those custom scripts. Many of them stretch back for over a decade at this point, that I've been kind of working on and developing and enhancing and so on and so forth. So that's a big perk for those of you that are at either TD Ameritrade and or Schwab. Remember, Schwab customers now have access to the Thinkorswim platform as well. For the longest time, that was not the case, but now that those two companies are joining forces, there might have been some of you who have been listening to us on these YouTube videos for years that have been kind of legacy Schwab clients that would have never had any use for our Think scripts since you didn't have an account at TD Ameritrade. Well, since things are changing in the brokerage industry, now you would have that benefit as well. We also have trade alerts, right? We have what we use is Telegram, where we have a private Telegram channel where we give you the invitation link once you join our 3-year program, and that way you can stay up to date with these different trades that we're doing. As you guys hear me say regularly during this presentation, I do my trades while the stock market is open for these Tuesday and Thursday videos, and I post those trades in our trade alert channel for the benefit of our premium members, so that way they don't have to wait until at night or the next day to find out about what the trade was. They can learn about it in real time while the stock market is still open and do whatever they need to do with that information. You're also going to have access to class forums. And so not only do we have class forums, but we have a private student Telegram chat group as well. So that way it's not just an experience where you're only associating with David and I as the instructors. You're also getting to know your fellow classmates, and that's really helpful, I think, for a lot of people as well, because sometimes you're a little intimidated perhaps to work with somebody that is at the front of the class, and maybe you're a little bit more comfortable working with somebody who's sitting next to you in the classroom, right? That sort of a thing, of course virtually, but nonetheless it can be maybe a little bit more of a calming experience for some. So we offer that availability with our class forums and things like that. We also have some trading plans. In my case, I teach 4 different individual trading rooms during the week, so you have access to those 4 trading plans. I create the sector selector, which we just reviewed a second ago. I also create the stock selector. I create the factor selector. I also offer a dividend tracking spreadsheet for those of you that are trying to keep track of all your fractional dividend payments that are hitting your accounts over time. We have access to a position sizing calculator. We have access to other forums beyond just the class forums, and then you're going to have priority support when you're emailing us at support@marketscholars.com. So this is not an all-inclusive list, but gives you a feel for the types of things that you would expect if you did take advantage of our Black Friday sale. So again, in order to do that, you can either click that little yellow button in the red banner up at the top, or if you're on this page that just is marketscholars.com/pricing, you could also just click that subscribe button down below there. You can also find it up here under the pricing tab. So there's a few different areas and ways that you can get to this. But once you click into it, then you're basically going to be taken to a page that looks like this, where you would fill out this information down below. And then here's the important part. It's a little bit hard to see, so that's why we always have to do our best to point this out. But underneath where you're posting like your zip code, there's a little bit of a kind of floating hyperlink. It's in orange font. It's right above where my mouse is right now that I'm kind of circling, and it says "Have a coupon?" ? And if you click that, then what will happen is it'll allow you to type that coupon code in there. And again, it's just Black and then Friday, where the B and the F are capitalized, and there is no space between the two. It is all one word. And then once you've applied that, you'll know if it worked or not by coming in here and clicking on subscribe right here. Remember, you're not putting in your credit card information yet, so don't hesitate if you're just checking it out or what have you. You wouldn't do that until a little bit later. But it's when you click that blue button there where it'll show you that your coupon code has been appropriately applied. And in that case, it would save you about $700. So anyway, for those of you that have been wanting to join Market Scholars for a while, and if you find this to be a good time to do it, you might as well take advantage of our offer there. So we look forward to seeing seeing many new faces in our classes here virtually as soon as next week. All right, let's get back on track, and thank you for the opportunity to explain all of that here in this video. Many of you know that David and I are not going to be the salesy type. We do these videos oftentimes 4 or 5 days a week, and we hardly ever talk about our premium side of the business other than to mention that it exists. So hopefully you didn't mind the 10-minute conversation right there that happens just a couple of times per year for all the free content that we provide you along the way. So thanks for bearing with me there. But like I said before, it's always helpful to have it on a recorded screen, so that way when people have questions about it, we can just say, hey, go back and watch that video, and we'll show you right on there where you would need to apply that coupon code. All right, back to the charts now. Let's do some 12 grid analysis, and we're going to get started here with chart 5A, and this is our asset class 12 grid. And we'll get started in the lower 2 corners, as we often do. And guess what? Both of them are still with the bearish postures, which is exactly what we want to see. In the lower right-hand corner, we have the 10-year U.S. Treasury yield, which was down just a skosh today. That was not a big move at all, but it doesn't have a major impact on today's trading, as today was a very quiet day for the stock market as well. So the 10-year Treasury yield ended at 4.41% here today, well off of where it was just about a month ago when it touched 5%. So the further down that we go in interest rates, the greater the chances that the stock market will be able to rise. And that's exactly what we've seen here in the last month or so as interest rates have been pulling back. So it's good to see them pull back again today, but it was almost a non-event. You could call it flat. And we're still basically at 1-month lows right here. We're not at 3-month lows, but we are at 1-month lows where we ended today with interest rates. You'll see here in the other corner we have the U.S. dollar. That also is helpful when it is bearish for most of the multinational companies in the United States. And today we not only have a bearish posture on it, but we do have a little green dot appearing here. Let me right click on this and maximize it because I want to double check. Yeah, I'm glad I did that because I couldn't quite tell just visually looking at it if it was under today's candle or yesterday's candle. It was actually under yesterday's candle. So notice after yesterday on UUP, which is what we use to track the progress of the US dollar, it's basically an ETF that is the US dollar versus a basket of other securities like especially the euro. But anyway, you'll notice here we've got this little green dot down below letting us know that that was a day when the red, the blue, and the green lines were all in the lower reversal zone below 20 on the same day. And so that also plots a green dot up above on the price chart. So this is the first one that we've seen on the US dollar in 3 months, which means that it wasn't entirely surprising to see the dollar actually close up today. That's not an aggressive day by any means, but knowing that yesterday would have been considered too much selling, this is maybe an opportunity for the dollar to have a quick little pop higher here. We'll see if it leads to anything or if it's just going to be an afterthought. But it is noteworthy enough because it's not one of those boy who cried wolf stories, right? This is the first oversold cluster signal that the dollar has had in 3 months. Going further back, I'm not sure. Let's go back 6 months. Same thing. We have not had an oversold cluster signal in 6 months. And then 1 year, here we do have some examples. So if you go back to April of this year, and then if you go back especially here to the end of last year, beginning of this year, we did have several examples of that. And they were kind of hit and miss. I would say that these examples work just fine if you wanted to revert to the mean with that. But these ones, it depended on whether you went with the early ones or the late ones. The late ones worked fine, early ones questionable. So hard to say where this one shakes out. I doubt a lot of people will trade UUP specifically anyway because it's just not a product that has a lot of juice behind it. You're not going to make a lot of money unless you're leveraged to the hilt with UUP itself. But it helps us more than anything else gauge what our expectations are for other asset classes based upon whether the dollar is strong or weak. So if we have an opportunity for the dollar to get a little stronger here in the short term, that could mean that the commodities might get a little bit weak, and perhaps even the foreign stocks might get a little bit weak. So we'll see if that takes place or not. Right now, I actually kind of like the way that gold is looking. Obviously that can change if the dollar strengthens in the short term, but right now I'm liking the bounce that is developing out of gold. We already had a good bounce on this day back here, November 13th. We went up for a few days, we pulled back a little bit, some back and fill, and now another big bounce. And now we're sitting here at a bit of a resistance area, but the momentum is in the favor of the bulls of gold right now. So I have no reason to believe why we would have to be forced to be stalled out at this area. We could very well breach it to the upside and start establishing newer, higher levels on gold. So let's keep our eye on that. Gold does have a strongly bullish posture here at the moment. Oil does not have a strongly bullish posture, but it has a weekly bullish posture. You can see the chart looks entirely different than gold. Here with oil, we're getting a bounce up and off of that oversold cluster signal here from 2 or 3 days ago, but we remain below a falling 30-day moving average. So that's one of those where we don't necessarily expect a trend change when we get a cluster. We expect a reversion, but most of those reversions will fail. And so right now, unless I'm proven otherwise, I'm going to assume that oil is going to have some challenging moments in front of it, despite a pretty decent little bounce in the last 3 days. In terms of our middle rung there, we were a pretty quiet day across the bond markets. Let's just call it flat. But from an intermediate perspective, all three of those bond categories do remain with strongly bullish postures. Bitcoin was up a little bit here today, holding its gains from a week or so ago. I noticed that CZ from Binance was in the news here today for all the wrong reasons. And the cryptocurrencies are still holding in there just fine. So, until that breaks down, you have to assume that, the bullishness is worthy of being respected at the moment. Even if you're not a cryptocurrency person yourself, just the recognition that other people do have a belief in it at this moment, and that's why the chart is going higher, is at least noteworthy. On the top rung here, we did have a little bit of a pullback there in foreign stocks, both developed and emerging. Developed was down 0.39%, emerging was down 0.63%. Both of those underperformed the U.S. market, and maybe that makes sense with today being a rare day where the U.S. dollar was up. In terms of our sectors now, in this case, rare day where we have all of them green, right? The last time I was with you, energy had a pink background chart, but today it went back to that light green color, not dark green like all the rest of the charts, but that light green color there. So it's got a weekly bullish posture, but those are the ones that are most precarious. You'll notice that energy is the only sector that is not trading above its 30-day moving average at the moment. All the rest of them are. Healthcare is also a bit of a laggard. You can see it's trading above its moving average, but in this case, the moving average is still pointing lower, right? So that moving average is yellow in that case, not green. All of the other charts besides energy and healthcare have the green tips of their moving averages, telling us that price is above the rising moving averages, and therefore the progress is being made. More bullishness is entering into the system. So, it was a quiet day. Can't really make too much out of the movements here today. Healthcare was actually the best performer, up 0.60%, perhaps as a result of that Medtronic earnings report. And then the worst performer here today was actually technology, with Apple, Microsoft, and NVIDIA all down. That's not entirely a surprise. It was down 0.81%. All right, let's go ahead and now get into our trade application example. And we're going to be going into the financials world for that. You can see here that the financials chart has been one of the stronger charts of recent memory, at least in terms of sector, strength out there. Financials are right up there with, technology and communications as, outperforming the other sectors on the board. So let's go ahead and take a look here at chart 3A. And a reminder, this trade was already done during the stock market today while the market was still open, and I sent out those notifications to all of our premium members when the stock market was still open. Here's what I ended up doing. ACGL is the ticker symbol. This is Arch Capital Group. Probably not a name that many of you recognize, but it is big enough to be in the S&P 500 now. So it's big enough, even if it's not a household name to most of you. But its chart looks quite a bit like a lot of other insurance charts out there. As I mentioned before, the insurance industry has been one of the kind of hidden stalwarts that not a lot of people are talking about. They don't make a lot of noise, but there are a lot of strong charts out there, right? Some of the others, would be something like Chubb, ticker symbol CB. It's a pretty strong chart right there. Aflac has had a pretty strong chart there, right? Even Progressive has had a pretty strong chart. So the insurance companies are a bit of a sneaky area that doesn't get a lot of press, yet just keep on working for their shareholders. Whether that continues in the immediate future or not, anybody's guess. But at least for the purposes of this trade, I kind of hope so. Because what I did here was a very basic trade. In this case, I did not use options contracts. Just didn't have a lot of liquidity there. Plus, a lot of times I like to be a seller of options contracts. I know CRISPR was the rare exception of where I was a buyer of one. But generally speaking, I'm more of a seller of options. And that can usually work fine in most market environments. But as most of you are aware, right now, the VIX is extraordinarily low. And with the VIX down here at 13, it has been extremely challenging to get credit spreads to be working appropriately. You're just not getting much juice out of selling premium at the moment, I'm sad to say, because that would typically be my preference in this video, not necessarily because I prefer options over stocks generally, but more to the point, I can customize my trade setup a lot better, and I can have defined risk and other things that I think are more appropriate for a YouTube video like this. So I did not do anything with the options here. This is just a straight stock trade. It's just a bullish swing trade is all it is, and basically playing the bounce up and off of that rising 30-day moving average right there. You can see on this chart 3A, that blue background color tells us that the blue near-term line on the market forecast is considered bullish at this moment. You'll also notice that it is easily outperforming the S&P 500's dotted gold line that you see down below here. And you can see that this has not been a recent phenomenon. They have green labels across the board on all of our time periods up above. Remember, if those were negative time periods, those labels would turn to red, but because they're positive, they're all green. So this is not a new story. The hope is that it just continues to do what it has done for the last year, which is to gradually go higher. And if that's the case, then hopefully we would stand a chance to make our max gain out of this. So like I do with a lot of my swing trades, it's just a 1-for-1 reward risk ratio, where basically I get in at the middle of the range. Our stop loss would be a couple of pennies below the low of that candle there on November 15th. And that means that our price target would be up here just a hair below the high that this was set back on November 1st. So it would not require a breakout above that level. It would just simply require us to get up to around that level. And if that was the case, we would pull it off at a profit. If it rolls over and breaches this prior candle, then we will get stopped out. So I'll let you guys know one way or another if and when those other rules trigger there. But that was kind of the basic idea here tonight, taking advantage of a bullish bounce trade on a underlying strong industry, kind of in disguise, that not a lot of people are recognizing as insurance being one of the stalwarts of this market right now. All right, that'll wrap me up for the day. I appreciate you guys checking this out. By the way, I will still be teaching my factor-based swing trading class tomorrow. So for those of you that are premium members, I'll be able to say hello and goodbye to you one last time before our Thanksgiving holiday. But for the rest of you, especially those of you that just watch these free videos here on YouTube, I want to thank you for checking out tonight's video. In addition to that, express my gratitude to you all for taking your investor education seriously enough to check out these videos, right? We're all in different stages of life, but we're all trying to get better day by day. And I think those of you that are committed to watching these videos are doing that very thing. And of course, those are the folks that David and I most enjoy working with. So anyway, appreciate you guys and your viewership and your support. I hope you all have a wonderful Thanksgiving with loved ones, friends, family around you. Enjoy some good food, maybe watch a football game or two. And then I'll be back in action on Monday morning for top-down trend trading. Remember, on Thursday, I'm not going to be doing the market outlook video because the market will be closed on Thursday for Thanksgiving. So I will see many of you early next week at some point. And again, look for your emails there to check out our Black Friday sale as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.